Have a great day, everyone. By the way, I am Anamar Gumahov, and for today's video, I am going to discuss my assigned topic entitled Prepare Financial Management, specifically the budgeting, the daily food cost report, the profit and loss statement, the balance sheet, and prepare and cost control. But before that, let me introduce to you my objectives. First, define what is financial management. Second, identify different types of financial management, and third, recognize and value the importance of financial management. Now, let's proceed to my topic. Let's define first what is financial management. If I say financial management, it refers to the act of planning, organizing, directing, and controlling financial activities such as the acquisition and utilization of funds of an enterprise. From the word itself, financial, which means it talks about money or finance. In other words, it is the application of general management principles to the enterprise financial resources or position. Indeed, in business, we need all the activities to function well. Why? Because in this activity, it is the vital to the health of an organization. So think about that. A business is like a human body part. So as we all know that if one system shut down, or if one system of our human body part shut down, then the others would slowly start to shut down as well until the body can no longer maintain homeostasis and the person will slowly die, right? So these body systems are interconnected and dependent upon one another to function. So like in business, this is the reason why it is necessary to plan, to organize, to control, and to monitor the financial resources with the aim of achieving organizational goals and objectives and every other thing that relates to money. And as what I said earlier, that when an organization properly manages its finances, then there will be an effective functioning of the firm. On the other hand, if the organization fails to properly deal with its finances, it is bound to face barriers that come alongside severe consequences on its growth and development. And I also found out that there are several options for the management of finances. So what are those options? So which can either be managing them on your own. So, if you are the owner of a business and you are having a allotted time to manage your business, then you can manage it on your own. You can also hire a full-time employee, and you can also hire a part-time accountant or a third party to manage all the financial activities. And again, as we all know that most organizations have a dictated department that is responsible for taking care of the financial matters of the company. Am I right? At kadalasan, tinatawag nila itong financial manager and finance department depending on the profile of the company. So, who is financial manager or what is financial manager? So, a financial manager is someone who is responsible for strategically planning, organizing, directing, and controlling the financial activities of an organization. So, they are also the one who look after the financial health of an organization. A financial manager critically monitors the finances of a company as well as carries out data analysis and provide advice to senior managers or ideas with regard to profit maximization. Oftentimes, they work as part of a team, providing assistance with regard to decisions that affect the organization and a task for which they need analytical ability and excellent communications skills. And financial manager has many roles or they are having a many rules. Included here, first, preparation of financial statements, reporting business activities, and forecasting. Second, monitoring financial details to make sure that they meet legal requirements. Third, supervision of employees that are responsible for financial reporting and budgeting. Fourth, financial report reviews as well as finding ways to reduce costs. Fifth, making analysis of market trends in order to find opportunities for expansion and acquiring other companies. And the last one, help in making financial decisions. So those are the roles of a financial manager. And also, financial managers, or there are different types of financial managers. Um, Included here are the controllers, the treasurers, credit managers, cash managers, risk management specialists, and lastly, the insurance managers. So, first, what is controllers? So, if I say controllers, they are responsible for directing the preparation of financial reports that summarize and forecast the financial position of the organization. So this includes the income statements, the balance sheets, and future earnings of expense analysis. They take charge of the preparation of special reports that regulatory governmental agencies require. So they often take charge and supervise the accounting, the audit, and budget departments. Second is the treasurers. So treasurers perform the role of directing the budgets of their organization in order to meet its financial goals. So I know that all of us encountered the word treasurers and know kung ano ang ginagawa ng mga treasurers, especially sa school. 'Di ba? Meron tayong mga tinatawag na mga treasurers, which is sila yung tagahawak ng pera natin. So, treasurers, they carry out supervisions on the investment of funds and employ strategies of raising capital, such as the issuance of stocks and bonds to support the expansion of the firm. Also, they develop financial plans for mergers and acquisitions. So, if I say merger, means two companies joining together, while acquisition means one company buying another. And the third types of financial managers is the credit managers. So credit managers oversee the credit business of their firm. They set criteria for rating credit, determining credit ceiling, and monitoring the collections of past due accounts. The fourth type of financial manager is the cash managers. Cash managers are responsible for the inflow and outflow of the company's cash to meet its business and investment needs. For example, it is necessary for them to project cash flow to determine whether the company will either not have enough cash and will need a loan or have surplus cash and can invest the surplus cash. The fifth types of financial manager is a risk management specialist. So risk management specialists are responsible for controlling the financial risk of their organization by using hedging and other strategies to limit or compensate for the likelihood of financial loss as well as the company's exposure to financial uncertainty. Among these risks, they try to limit are those that occur as a result of changes in currency value or changes in the prices of commodities. The sixth type or the last type of financial manager is the insurance managers. So insurance managers take decisions with regard to the best ways of limiting the losses of their company by obtaining insurance against risks. This can include the necessity of making disability payments for an employee who sustains an injury while carrying out his job. So, ang insurance managers, they are the one capable to sustain the needs of the staff, if ever, for example, mayroon silang staff na nahulog sa hagdan. So they are the one who manage the money for uh, for payments in the hospitals, or for they are the one who responsible for the insurance of the staff. And also any cost that lawsuit imposes against the company, or the property loss resulting from fire, or maybe typhoon, or other types of um, property loss. So those are the types of financial managers. And now let's proceed to the functions of finance management. So the following points describe the importance of financial management, or how financial management functions. The first one is the budgeting. So budgeting, this is important for all organizations, including food service and catering units. All activities are planned and undertaken, and also keeping in mind the finance available. So budgeting involves planning for allocation and use of financial resources and accounting.
Small business owners juggle a lot of roles. Sometimes it's easy to fall behind on the basics, like maintaining a business budget. Budgeting is the perfect chance to see where your money is going so you can spend less and save more. Here's how to get started in 4 easy steps. First, add up your revenue. This is all the money your business earns from sales or services provided, interest, fees, and more. Next, estimate your monthly expenses. These are the costs related to running your business. Each expense is either fixed, meaning it stays the same every month, or it's flexible, meaning it changes every month. Here are some examples of fixed and flexible expenses. Once you've listed every expense, add them together to get your total expenses. Next, figure out the difference by subtracting your total expenses from your total revenue. If you get a negative number, you're spending more than you're making. Don't worry. If you're overspending, you can always balance your budget and identify areas where you could spend less to get back on track. Make sure you track your revenue and expenses every month so you know whether you're overspending or spending within your means. It's just one way to keep your business healthy and growing long into the future.
Second is daily food cost report. So the daily report is usually a simple statement containing total food costs, total food sales, and cost for percentages. Managing food costs is one of the most critical aspects of running a successful food service operation. Having procedures and tools in place to track sales and costs to help to identify any possible issues and create the opportunity to remedy the problem before it gets out of control.
Understanding how to calculate your food cost percentage is essential for every restaurant owner. If you're in the restaurant or food service business, you understand how important it is to keep your costs under control. Being able to compare and calculate your food and beverage costs month over month can be really helpful in the overall management of your business. So how do we calculate food cost percentage? Well, food and beverage costs are calculated as a percentage of the total volume of sales. First, calculate the amount that you spend on preparing a dish. Take all the ingredients that go into that dish and add up the numbers to find your food cost for that item. Next, divide your food cost by the price of that dish. Let's say, for example, that it costs you $1.50 in ingredients to make a burger and fries, and you charge $5 for that meal. $1.50 over 5 is 0.3. Take that number and multiply it by 100, and we get a food cost percentage of 30%. Once you have the food cost percentage of items on your menu, you'll be better equipped to determine if you need to raise or lower your prices to cover your overhead cost. You'll also be able to appropriately change either the menu price or type of ingredients you use if the prices of the ingredients fluctuate. Don't forget that every restaurant will have different food costs.
The next one is the profit and loss statement. So an income statement or profit and loss account is one of the financial statements of a company and shows the company's revenues and expenses during a particular period. It indicates how the revenues and transform into the net income or net profit.
A profit and loss statement, or P&L, is an account compiled to show gross and net profit or loss during a specific time period. Profit or loss is equal to your income minus your expenses. For example, you manufacture widgets and sell them to your customers over the internet. During the month of June, your income was £10,000. The first expense you need to subtract is direct expenses. A direct expense is any cost directly related to the production and sale of your product, such as raw materials, shipping costs and labour for assembling the widgets. For this example, your direct expenses are £4,000. This gives you a gross profit figure of £6,000 or 60% gross profit. Next, you need to remove your operating expenses from your business during the month of June. This can include advertising, accountancy fees, heating, lighting, rent, salaries not directly related to sale, and more. For this example, your operating expenses are £4,500. So if we take the income, remove the direct costs and operating costs, this gives you a net profit of £1,500. If your figure is a negative, then you've made a loss during this period. Profit and loss statements show you how much money you're making or losing in a specific time period. They allow you to compare past performance and detect any issues with sales margins and expenses.
And number 4 is balance sheet. So in financial accounting, a balance sheet is a summary of the financial balances of an individual or organization, whether it be a business partnership, a sole proprietorship, a corporation, a private limited company, or other organization such as a government or not-for-profit entity.
A balance sheet is a statement of the assets, liabilities, and equity of a business or other organisation at a particular point in time. A balance sheet can also be described as a snapshot of a company's financial condition. A balance sheet is broken up into 3 sections: assets, liabilities, and equity. The difference between the assets and the liabilities is the equity of the company, also known as net assets, net worth, or capital. So, you're starting a business. You go to the bank and get a loan. On your balance sheet, this loan shows as a liability, as it has to be repaid to the bank. It also shows as an asset for the same amount as you have the cash to spend. Thus, the balance sheet is balanced. You need to buy a computer for your new business. The cash in your assets decreases, but your new computer asset helps balance this. As you sell to your customers, your profits are recorded as retained earnings in the equity section. The cash from these profits is recorded in the assets section and the sheet remains balanced. Every month you make a loan payment to the bank. Your liabilities reduce by the amount of the payment and your cash is reduced by the same amount. If at any point you need to find out your business's worth, go back to the formula from before. Assets minus liabilities equals equity.
And lastly, prepare and cost control. So cost control is a practice of identifying and reducing business expenses to increase profits. And it starts with the budgeting process. Cost control, in its simplest form, tries to influence business leaders' decisions so that the company can meet its goals. Also, the aim of controlling the cost is to make sure that the financial statement doesn't have any mistakes or aberrations. So this is because correct data can help cut down on the cost of overspending and help explain why there is a difference in the baseline. So this can also have an effect on the company's cash flow and profit statements. So cost control in a business include looking at operational cost, planning, coming up with the cost structures, and then putting those structures into place.
Hi, welcome to Education Leaves. In this video, the topics I am going to discuss are, what is cost control, how to cost control, and why cost control is necessary for a business. Let's start the video. What is cost control? Cost control is the practice of identifying and reducing business expenses to increase profits, and it starts with the budgeting process. A business owner compares the company's actual financial results with the budgeted expectations, and if actual costs are higher than planned, management needs to take action. As an example, a company can obtain bids from different vendors that provide the same product or service, which can lower costs. Cost control is an important factor in maintaining and growing profitability. Controlling costs is one way to plan for a target net income, which is computed using the following formula. Sales minus fixed cost minus variable cost is equals to target net income. To reach the goal, management reviews both fixed and variable costs, and attempts to reduce the expenses. Inventory is a variable cost that can be reduced by finding other suppliers that may offer more competitive prices. Outsourcing is a common method to control costs, because many businesses find it cheaper to pay a third party to perform a task, than to take on the work within the company. Now move on to, why cost control is necessary for a business. 1. Profit-making capacity of a business is guided by the efficiency with which various costs are controlled. 2. Cost control leads to increase the efficiency in use of material, machinery and labor. 3. Cost control provides a basis for cost reduction. Cost reduction is necessary in order to stand in competition in a specific production line, and reduce the selling price of a product to grab the market.
So, in conclusion, I just want to be clear that why is financial management important? So, the importance of financial management in an organization cannot be overemphasized. It is important in the aspect of maintaining financial stability and protection from bankruptcy. And also, it is important in every industry such as finance, construction, manufacturing, and others.
If you don't have control of your finances, you don't have control of your business and the fate of your business. Financial management deploys funds optimally towards hiring talent, paying suppliers, investing in R&D, and other initiatives that will drive profitable customer acquisition and retention. Effective financial management can help your business operate smoothly without running out of cash, improve profitability, and prepare for long-term sustainable growth.
And I think that would be all about my report. And before I end this video, I just want to motivate everyone, and I just leave a a simple verse which is can help if there is someone suffering and struggling right now. In Psalm chapter 37 verse 5, commit your way to the Lord, trust in Him, and He will act. So when you commit your ways to God, He is busy working on your behalf. You can move ahead with confidence, knowing that God is helping you with each new step. And that's all. God bless everyone, and thank you.